Hi, I'm Jimmy. In this video, we're going to do a quick review of where the US economy stands to see if we can use various economic indicators and information like that to try to determine if a recession is coming soon, and in theory, a meaningful pullback in the stock market. Or is the economy moving along decent enough and will the stock market move higher? This is the second video in our quarterly economic analysis series. So there are some economic indicators which generally do a good job of looking at where the economy is at, and some that are good for predicting where the economy will go. One of the leading economic indicators is housing. Now, we've looked at a lot of these charts in the last video that we did in our economic analysis series. So if you're interested in seeing that, or if you're curious more about how we started this, well, there's a link in the description below to that video. Okay, so this is a chart of housing starts. And basically, housing starts looks at how many new houses are being built. Oftentimes, a strong housing demand can lead to a robust economy. As more houses are being built, more people buy furniture, they buy appliances, things like that. So in theory, a strong housing market should lead to a stronger overall economy. Now, in our last video, this is where housing starts were. And this looked like a pretty big drop off at that time. And although I do want to point out how volatile this indicator actually is. Now, the early signs were that this was negative, but we wanted to see where it went. In the meantime, we had marked this as a negative for the economy. But frankly, now I'm not so sure. I don't think it's a positive because really what we're looking for is this. To me, this looks more like it's flattened out here at the top. But I'd have trouble saying that this is either a positive or a negative thing for the economy. So on our handy scorecard here, we're going to mark this one as neutral. This gray area in the middle, we're considering this neutral for now. Okay, moving on. Our next economic indicator is the ISM Manufacturing PMI Index. You might also hear this called the Purchasing Managers Index. Basically, this economic indicator tracks the changes in production levels from month to month in the manufacturing sector. So in theory, better manufacturing, stronger economy. So this is the chart from 3 months ago. And as we could see, it wasn't looking too good. Well, since then, things have gotten worse. So if we jump back to our scorecard, well, on our scorecard, we had this as a point for the bears. And it seems that our updated data has confirmed that this is a negative sign for the economy right now. Okay, up next, we have unemployment. Now, unemployment is not a leading economic indicator, but I do think it can do a good job of helping us paint a picture of where the economy stands right now. So in our last video called, Should I Invest Now or Wait Until Later? Well, I got a lot of pushback on unemployment. So much so that I actually did a video specifically on unemployment. And if you're curious about how unemployment works or looking at a deeper dive of what goes behind the unemployment number, well, there's a link in the description below to that video. But here's the long and the short of it. Last time I showed a chart like this, and I said something along the lines of unemployment is low, so that's a good thing for the economy. And I suppose it's not terribly surprising, but I got a lot of pushback saying, well, if unemployment is low, it has to rise, and therefore that's a negative for the economy. And yes, it will absolutely go back up, which is a bad thing for the economy. But the question is when? Now, if we were to switch to a shorter term unemployment chart, well, I agree that it's unlikely that unemployment will continue to fall. But there's another possibility, and that possibility is that unemployment could trend sideways for at least a little bit. And in theory, once we hit full employment, well, wages should rise at a faster pace. And if we overlay wage growth on top of this chart, well, we can see that this is the exact thing that's been happening. As unemployment has fallen, well, wages have begun to rise at a faster pace. That alone could help push the economy forward. So you don't necessarily need falling unemployment. A stagnant unemployment with rising wages could essentially do the same thing. Now, unemployment, once again, is not a leading economic indicator. So I think we should limit how much we weigh this into our decision-making ability or into our decision-making process. But I do think it makes sense to consider where unemployment's at and consider the fact that wages are rising. Okay, so jumping back to our scorecard here, I think unemployment gets a check for the bulls. So if we had a green check mark, 1 point for the bulls. Okay, next we have consumer confidence. Now, where unemployment is not a leading economic indicator, consumer confidence is. Now, just to illustrate that, this is a chart of consumer confidence leading up to and into the Great Recession. This line right here, this is the high of the S&P 500. And as we can see, consumer confidence was hesitating a bit leading up to it, and it looked like it had started to trend lower right when the market was hitting its high. And if we were unsure about the direction at that point for consumer confidence, well, perhaps we would have been more convinced when consumer confidence continued to fall from above 90 to below 60. And if we had reacted at that point, well, right there, the market was down about 17 or 18% compared to its eventual fall of more than 50%. Well, fast forward to today, and here's what today's consumer confidence looks like. And just so we're all on the same page, this index is actually called the Michigan Consumer Sentiment Index. And basically, its goal is to capture the mood of consumers as far as their economic well-being and their outlook. So compared to pre-Great Recession levels, it seems that this indicator looks quite good. Now we jump over to the yield curve, or more accurately put, the inverted yield curve. So the inverted yield curve is a key indicator, and I actually did a video just recently on this topic. And if you're interested, it could be worth the time because the yield curve has been inverted for a while. This footage was actually taken from that video. There's a link below if you're interested. But currently, the yield curve remains inverted. And we know that because the 3-month treasuries are paying a higher yield than the 10-year treasury does. And as we pointed out in all of the inverted yield curve videos that I've done, well, this is a big deal because all US economy recessions have been preceded by an inverted yield curve. Now, not all inverted yield curves have led to recessions, but this simply shouldn't be ignored. This is absolutely a point for the bears. So we'll mark that down in the chart here. So our final indicator isn't really an indicator at all. In fact, it's the ETF money flows. So basically, we look at how much money, how much net money, so money bought in, money sold out, how much was remaining, how much has gone into or out of different ETFs from different types. So I took a universe of about 350 of the largest ETFs, and then we looked at how much money went in and out of each of those funds over the past few years. I figured that if we can see actual money, where's that actual money being invested, perhaps we can use that to guide us to recognize at least what the big money is thinking. So here are the flows for 2017, 2018, and 2019. Now we're almost halfway through 2019, so I'm actually going to double up the 2019 numbers just to make them a bit more comparable to the two other groups. Now, what interests me the most is not that these numbers are trending lower, but it's how they compare to each other. So the fact that they're trending lower could easily be related to the fact that there are more ETFs available in 2019 than there were in 2017, and I kept the universe the same for all 3 years just to take a sort of a sample size. The biggest thing that jumps out at me with this chart is the fact that fixed income took in more money than equities in 2019. Now, fixed income is bonds. So basically, this is important in my eyes because this implies that a lot of big money is looking for safety, which would imply that there's a hesitation about investing in stocks right now. And if we dive deeper into just the bond categories, well, there we can see that government bond investments are way up in 2018 and 2019 compared to 2017. They're the green bars. And this actually confirms the belief that there's at least a partial flight to safety happening right now. And just so we're on the same page, with this chart, I actually doubled the 2019 numbers, just like I did to make up for the fact that we're only halfway through the year. So it's an estimate, but either way, the point remains the same. So my opinion is that it appears that things are a bit more negative this time than they were a few months ago when we did the video last time. Now, I don't like the fact that the yield curve is inverted and remains inverted for as long as it has. I think that's a negative. The trade tensions can't be helping manufacturing, and we should watch housing starts to see which direction that goes. Once again, I'm landing in the same spot pretty much, maybe a bit more hesitant than last time as I was in the last video. And that is that we should remain fully invested, but I think it makes sense to hedge our portfolios if we haven't done so yet. Now, if you're curious about seeing a video on how to hedge your portfolio, let me know in the comments below. I'd be happy to do something like that. And basically, it's time to take a defensive stance, a safety stance. But what do you think? Do you think that the economy is going to get stronger or weaker over, let's say, the next 12 months or so? Are you fully invested? Do you think that we should hedge our portfolios? Let me know what you think in the comments below. And don't forget, I'll be updating this series every quarter from now on. And if you're curious to see a hedging video, let me know in the comments below. So if you haven't done so yet, hit the subscribe button. Thank you so much for sticking with me all the way to the end of the video, and I'll see you in the next video.